Good afternoon and thank you for joining us. My name is Richard Johnston. I'm a Chartered Financial Planner here at AAB Wealth, and later we'll be joined by my colleague Duncan Raggett, Insolvency Practitioner at AAB. Now, as you'll appreciate, we're all working from our lounges and dining room tables these days, but under normal circumstances, Duncan and I are based out of AAB's office in Edinburgh. And you'll see from the visual behind me here, I'm paying homage to that, looking over Dundee Street. Today's webinar will last about 45 minutes. We encourage you to ask questions, but we will deal with those after the event on an individual basis, and you'll be given the prompt to send those to us in an email thereafter. I'd like to start with a story, however, and one about mountaineering of all things. Back in 1865, the British climber Ed Whymper, along with his team, became the first to conquer the Matterhorn. Now, when they reached the summit, they naturally celebrated, but unfortunately that proved to be premature, because on the way down, one of them slipped, taking 3 with him, and that day 4 died. Now, this is not in fact an uncommon thing with mountain climbing. It's well known now that the descent is a much more risky endeavour than the climb itself, and it's known that most deaths on Everest, for one, happen in that initial part of the descent where it is at most steep. Now, whilst it's nowhere near as dramatic as mountain climbing, there are similarities here with retirement planning. So we all work hard and take some risks along the way to build our wealth throughout our working lives, with the view of building enough wealth to cover our expenses throughout retirement. But once we've given up that ability to generate further income and are now reliant on that, we are now subject to a lot more risk than before. And I'd like to address some of those risks today, and I'm going to do so using the case study of a contractor who also has a personal service company. So you may have seen this agenda before. I'm going to cover briefly some of the options for drawing funds from your PSC, and also separately I'll consider how you can truly determine if you can retire and the risks associated with that retirement journey. And later Duncan will cover the options for closing your PSC if that's still relevant to you. So moving along, I will introduce to the protagonist of our case study, that being Derek. Now, Derek lives in Edinburgh with his wife Julie. They met 30 years ago when they were working at RBS together, and Julie still works there to this day. But Derek, 10 years ago, took a risk of his own by leaving RBS, setting up his own PSC, which he refers to as DW Consulting Limited, and he has been contracting ever since. However, he's a bit fed up at the moment, and that's because his contract ends at the end of this month and there are no others on the horizon. In fact, he knows that he'll no longer have any use for his PSC. So the idea is to close that and withdraw the funds in an efficient way as possible. Now, Derek does have the luxury of a permanent offer on the table from Aviva, and they are offering him 50,000 per annum. But quite frankly, he doesn't want to go into a permanent position, and also that level of remuneration, whilst fine, is nowhere near what he is used to. So all in, Derek is also very keen to retire, and Julie would retire with him at the exact same time if they were able to do that. Now, a couple of facts about his PSC itself. The trading year end is not until the end of May next year, but because his contract's ending soon, he knows that the total profit, certainly at this point in time, would be £100,000. He hasn't made any withdrawals from the company in this trading year, so we've got a clean sheet to play with here. What's in the company? Well, it's just cash at this point of time. 2 accounts, 230 from one, been an accumulation of funds not drawn over the years, and also he's kept a tax reserve of 19,000, and he's basing that on 19% off the 100,000 profit he expects to have. So moving along, for Derek, we have a conversation about the various options, and these may not be new to a lot of you. Whilst the PSC is in place, he can consider salary, dividends and pension contributions. Now, if we think about each of the pros and cons of these, corporation tax liability, we know Derek's company has this, so the only thing that will attack that is salary and pension contributions. Derek's personal income tax liability, well, we know salary and dividends will be taxable on him, but he's got his allowances to play with. Pension contributions, well, you get a bit of both with them. You don't get an initial income tax liability, but when you draw those pension funds at a later stage in time, income tax would be payable, albeit if he has a flexible plan, he can control those flows. We've already assessed that Derek does not have a full state pension entitlement yet, so if he's not drawing salary from the PSC, we know that he would need to make voluntary contributions, which cost about £800 per annum in order to top that up. Obviously, if he were to take the Aviva contract, that would work towards that as well. But we're working on the basis at this stage in time that he doesn't take up that Aviva contract, so a salary from the PSC could be helpful there. And national insurance, well, isn't that really just another form of income tax? It only applies to salary, however, and again, there are allowances which we can play with there. And of course, the end game here is closing the PSC itself, and that's what Duncan will cover later on. So moving along, what do we do for Derek in particular? Well, we look at various matters relating to his affairs and the PSC itself. And the thing that's jumping out with this one is that his trading year, because that's not aligned with the tax year, we know he could take lots over the space of 2 tax years. So our advice here is for him to take a salary of £9,000, dividends of 41,000 and a pension contribution of 40 in this tax year, and then again next tax year between the 6th of April and the 31st of May, and all of that will attack this year's trading year. So the salary of 9,000 we're keeping at that level. That's not enough to pay national insurance, but it's enough to make sure he gets the state pension credit. We're keeping the dividends at 41,000 here because that's enough to keep Derek as a basic rate taxpayer from a personal position, and he's got enough distributable reserves from previous years to be able to make dividends of that value. And pension contributions wise, he doesn't have any carried forward annual allowance from a pension perspective, but we know we could put 40 in this year and 40 next year. And what does that do to the numbers in the company? Well, it reduces the corporation tax liability significantly. It hardly exists now, in fact, and ultimately too, the company is left with just £69,000 of cash. Now that 69,000 is something that would be dealt with when the PSC is closed itself. So now we can move along to the concept of whether Derek and Julie can actually afford to retire now. And what we're going to do is assess 2 scenarios. They retire now or they keep working for 3 years. And the reason why we're going to 3 years here is because Derek feels that if he were to take up that permanent position with Aviva, he wouldn't want to join and maybe leave after a year. By the time he gets his feet under the table, etc., he feels he'd want to give them 3 years if he starts it at all. So we're going to consider that. Now, we have to do a lot more than just look at the PSC here. We need to look at Derek and Julie's total financial position, and we need to think about all of their assets, income streams and liabilities. So by assets, in this instance, Derek has a SIP that happens to be worth £800,000, and of course that will be topped up by the £80,000 contribution from the PSC. Julie happens to be a member of the RBS defined benefit scheme, and depending on exactly when she retires, it'll pay her about £11,000 per annum of a very secure inflation-linked income. And of course, they have their 2 state pensions, which do a similar thing, and then they have their main residence. Now, what we do with this is we input all of this information into our cash flow model, which I'll show you now. And we input it into our software and we run through these models real time in the meeting with Derek and Julie. That allows us to go in and out of different scenarios, considering different issues that arise and having a proper in-depth real-time conversation. But for the purposes of this presentation today, I'm just showing you a couple of graphical outputs from that. If we just go to the bottom chart for now, this shows their assets, and it's quite a simple chart, of course. The bottom purple tranche just shows their main residence, and it'll grow gradually over the years according to this model, and ultimately be inherited by their son Matthew whenever they're in their late 90s. Now, this is something they actually want to happen. They don't want to release equity or downsize that property. They want Matthew to be able to inherit that property. That's very important for them. The large green slab above that represents Derek's SIP, which has investment returns associated with it, but also withdrawals will be made over the years, and ultimately that is projected to run out in their early 90s. The more important chart here, however, is the top one. That's the actual cash flow model. Now, if we look at the top, we see a black line running across. That represents Derek and Julie's projected total expenditure over the rest of their lives. Now, it bobs up and down a lot in the initial years because of tax differences. So this does consider the actual tax that they pay depending on where the funds are coming from, and also gifts they intend to make to their son Matthew, who's still at university, and also they wish to gift a lump sum to him so he can get on the property ladder himself in due course. The thin line underneath that in the middle of the chart, which runs along, that represents the level of their essential expenditure. So that covers things like groceries, heating, council tax, that sort of thing, whereas the black line is total expenditure, and the difference between the two is really discretionary expenditure. So essentially the good stuff in life, like eating out, traveling, that sort of thing. The conclusion that we draw from this model for Derek and Julie is that in their mid-90s, whilst the RBS defined benefit income and the two state pensions appears to be sufficient to cover their essential expenditure for an indefinite period almost, there is a red area which represents a shortfall showing there, and that's when Derek's SIP runs out, and that's being used to cover the discretionary expenditure. So it shows then that they will run out of money at that stage. Now, we have a conversation about this, but Derek and Julie are quite comfortable with that being the position, given that that's in their mid-90s and at least their essential expenditure is being covered. So the conclusion from this is Derek and Julie could, if they worked for another 3 years, retire comfortably. However, they don't want to work for another 3 years. They're very much at the end of their tether. So let's look at the next scenario, moving along to a model which shows if they retire now. And you can see here, jumping straight out at us, a large red slab. Basically what's happening here is that despite retiring only 3 years earlier, they are running out of funds a whole 10 years earlier, and this is in their early 80s. Quite frankly, it's an uncomfortable position for Derek and Julie to be in, and I as an advisor wouldn't be very comfortable with it either. They are both in particularly good health and could quite easily surpass that age. So something has clearly got to give here, and we have to have a conversation with Derek and Julie about what they may be willing to give up and not. Now, in terms of their expenditure, we have gone through a process to work out what this might be, and they are expecting that, or wanting it to be, £56,000 per annum of expenditure, and for that to be inflation linked over the years. And also I mentioned the gifts to their son. So they don't really want to give up any of these things, quite frankly. They have plans, they wish to stick with them. So they're between a bit of a rock and a hard place here. They don't know what would be reasonable to give up. Now, in a few minutes, I'll come on to what we can do to help them with this. But I also point out to Derek and Julie here that there are a couple of shortfalls to a model process such as this. Firstly, it has to assume a certain level of investment return for Derek's SIP, and that's material to this. Now, in this instance, we've assumed a rate of 6.1% per annum average annualized growth. We have a robust process for trying to identify that. We use external consultants to help us, but quite frankly, you and I both know there are no guarantees with that. It's very difficult. You just cannot predict that with any degree of certainty at all. And the same can be said about inflationary returns, which are assumed to be 2.5% per annum for the purposes of this model. The other shortfall with this sort of model is that even if you do actually end up having 6.1% average annualized growth in the portfolio, it's not going to appear like that. Some years you're going to have double-digit positive returns, perhaps double-digit losses. It's that's the volatility associated with the stock market. You have less volatility these days with inflation, in fairness, but I can tell you over the last 100 years, inflation's been as low as -26% for a given year, or as high as +23%. So there's great potential there as well, especially when you consider the money printing that has been performed in recent years. So we've got to address these shortfalls as well, especially for a borderline case like this. So moving along, what we do for Derek and Julie is we, as well as using a forward-looking model here, we can do a back test as to what has actually happened in the past. And when I say the past, I'm talking about the last 105 years. That's as far back as we can get reliable data. And this is data as well based on a portfolio of an allocation similar to Derek and Julie's. And because of all of the portfolios we use are very low cost diversified portfolios, we can measure it in that way. With concentrated portfolios, it can be more difficult to do that. So what we can do here is look at the situation. If Derek and Julie were not retiring here now in October 2020, but hypothetically retiring in a month in any of the years over the past 105 years, so we're literally looking at hundreds of scenarios here, and we can see that only in 25% of those scenarios would Derek and Julie not have run out of money, which is obviously not a good result at all. And we can see as well that the worst scenario that would have played out in terms of all the stock market returns, inflationary returns, and this also considers Derek and Julie's state pension and RBS income because they're coming in at different times. The worst case scenario would be if 1915 to 1950 was to replay, basically, and we're assuming, by the way, that they survived for 35 years. And you don't need a history lesson from me to explain why 1915 to 1950 was such a terrible time, obviously from a human perspective, but also from a financial perspective. And that happens to show that in that scenario, they could have only afforded to spend 43,000 per annum in retirement, not 56,000. Now you might say, well, 43 is okay, surely they can get by in that. But the problem is if they begin their retirement journey spending 56 and do that for some years, and this is the actual scenario they are playing out without knowing that, then they're not even going to get to spend 43 in the second half of their retirement because they will have depleted the pot so much. Now, if we move along, we can look at the same data in a different chart. Now, this shows three lines. This shows the best, median and worst case scenarios from that data set. Now, the top green line is really not one to worry about. That's the best scenario in those 105 years. This shows that if those inflationary and stock market returns were to repeat, Derek and Julie would not run out of money, and in fact their son Matthew would inherit a SIPP worth about £2 million when they die in their 90s, not to really worry about it, clearly. The bottom red line represents that worst case scenario, that 1915 to 1950 scenario, however, and you can see it crashing and burning in their late 60s, which is a great concern. Is that likely to happen? Well, based on historical data, no, that's literally the worst case scenario, but that would obviously be a huge concern for them. The blue line being the median line shows the money running out in the early 80s, which also echoes the cash flow model I showed you in the previous slide. So the lesson here is the reason why there is such a risk with this sort of decumulation phase, this descent, if you like, in retirement, is that when you are drawing sums from a pot and the stock market falls, those sums do not get a chance to recover. Now, we all know that the stock market has historically recovered after a fall. If it had not done that in the past, well, the stock market would not be what it is today. Of course, it has always recovered. It may sometimes take longer than other times, but it does recover in value. But if you are drawing sums out every single year, the sums you draw out do not get that chance to recover. So even if you experience that average annualized growth of 6.1% per annum, it's the actual sequence, the timing, and how strong those downturns are, which can make a huge impact on how sustainable the pot is. So a natural answer to this may be, oh, well, if the stock market falls by 20%, Derek and Julie reduce their expenditure by 20%. But obviously, reducing your expenditure by that amount is a huge shock to your lifestyle. It's not something that people could normally accept without making significant changes, and it certainly would not be comfortable. But what we can do for Derek and Julie is we can look at a variety of different ways which are all based around tapering, slightly perhaps tapering their expenditure after downturns and monitoring that. So in this position, moving along, what we look at for Derek and Julie and ultimately agree is this rule. And this is a rule that we are going to apply for them. Now, what we're going to do is monitor the withdrawal rate and reduce it if there is a fall. So what we'll do at the start is measure the starting withdrawal rate. Now, what does that mean? So let's say you've got £1 million pot and you're drawing £50,000 per annum from that. That's a 5% withdrawal rate. 50,000 divided by £1 million is 5%. Now, if that 5% were to become 6% or more, then we want to reduce their withdrawals. Now, why would the 5% become 6%? Well, it's because the stock market has fallen. In that same analogy, that £1 million pot would need to fall to 830,000. So by quite a lot, really over 15% before that withdrawal rate would increase to 6% or more. And if that happens, what we're saying to Derek and Julie is, look, the stock market may have reduced by 15%, but you just reduce your withdrawals by 5%. For that year. And the good thing as well is in the good years where the stock market grows and the withdrawal rate goes below 4%, which is because the pot has grown by a faster rate than we had projected, then they can increase their withdrawals by 5% as well. So it's not all bad. And also we only need to impose this rule for the first 10 years. Remember the Everest analogy? The most dangerous part is at the beginning of the descent. So if we agree this rule with Derek and Julie, we can then analyse that, and you'll see already from the chart underneath those words that the same backtest shows all scenarios working out. Even that worst case 1915 to 1950 scenario works out in that backtest here. So that gives a much greater probability of success with modest levels of tapering based on how the market performs. Now, if we move along now and look at a corresponding chart similar to the one you saw before, now this one looks a bit more complicated this time. You see the reds actually above the blue and the green at the beginning. And that's because, remember, this is the 1915 to 1950 scenario. So very poor stock market returns here. And what's basically happening is Derek and Julie are having to pull back on their expenditure on a gradual basis. But what it means is that it doesn't run out of money until their late 80s here, which is a much more acceptable age. And remember too, this is the worst case scenario back tested. It's not the likely scenario. That's the blue line, which is absolutely fine here. And by the way, the reason why those success figures don't reach 100% is simply because there are no guarantees with this sort of thing. Now, the only way to have guaranteed income here is for Derek to use his SIP to purchase an annuity, which is index linked. And obviously we have a discussion around that, and that can be very important for some people, but in this instance they would certainly not be able to spend £56,000 per annum to start with, given the cost of that insurance. And also, of course, they would have less flexibility as a result of that. So it's useful for some people an annuity, but for others, and certainly for Derek and Julie in this instance, we're not advising that they go down that path. So moving along, the plan here is for Derek and Julie to do this job properly. We need to consider a strategy for each asset, income stream and liability. We want to simulate and visualize that using our cash flow modeling software, which enables us to have an in-depth real-time conversation with Derek and Julie to find out where their red lines are. And we want to analyze the probability of success of this, especially where it's a borderline case. And also we want to review this on a regular basis. You can't just do this at the start of retirement and then just leave it. You need to do this regularly. And so in addition to when we meet Derek and Julie each year, obviously we'd be talking about the performance of Derek's SIP. We're managing the investment portfolio within that, and the market may have gone up, the portfolio may have gone up, it may have gone down, and we can talk about all of that. And that's very interesting, but quite frankly, a lot of that is arbitrary in terms of the actual value of the set. What really matters is what does it mean to Derek and Julie in terms of what they can afford to spend, because that's what's dictating their lifestyle a lot of the time. So as well as talking about investment returns, we can actually show what the impact is of that and manage it in a way which makes it more comfortable for them. In summary, I think it's fair to say that when it comes to mountain climbing, you probably should defer your celebrations until you get back down to the bottom of the mountain. Now, clearly we cannot use that same analogy with retirement planning, but perhaps the answer here is to only celebrate retirement when you have performed a proper, robust analysis of whether you can afford to retire, and that would then enable you to retire with confidence. Thank you. I will now pass you over to my colleague, Duncan Raggett.
Thanks, Richard. Just to introduce myself, I am Duncan Raggett, head of the Restructuring Recovery team at AAB, an appointment-taking licensed insolvency practitioner, or IP. I'm here to discuss the options you have to close down or wind up your company and extract the remaining assets and cash in a tax-efficient way. The main options being either voluntary strike-off or members' voluntary liquidation, MVL. With the IR35 regulations coming into force next year and the likelihood of tax increases in the next budget in order to pay for the massive government expenditure for the COVID-19 support schemes, now is the time for directors with PSCs like DW Consulting Limited to act in order to maximise the potential returns. Firstly, I will discuss voluntary strike-off. The voluntary strike-off of your company is a quick, inexpensive way to close off and dissolve your company, provided certain conditions apply. However, if you still have assets or over £25,000 to distribute from your company, then it may not be the best option from a tax perspective. You can make an application to strike off the company if, in the last 3 months prior to the application, the company has not traded or otherwise carried on business, the company has not changed its name, the company is not engaged in any other activity except one which is necessary for the purpose of A, making an application for the strike-off or deciding whether to do so, i.e. seeking professional advice on the application or paying the filing fee for the strike-off application, B, concluding the affairs of the company such as settling trading or business debts, C, complying with any statutory requirements such as lodging accounts, or D, making a disposal for value of property or rights that immediately before ceasing to trade or otherwise carrying on business it held for the purpose of disposal for gain in the normal course of trading. A company cannot apply to be struck off if it is the subject or proposed subject of any insolvency proceedings such as liquidation, including where a petition has been presented but not yet dealt with, or a Section 895 scheme, that is a compromise or arrangement between a company and its creditors or members. The advantages of striking off a company are that it can be done directly by the directors and doesn't require a liquidator. There's only a £10 charge for the submission of application to Companies House, so it's a cheap process. It's also a very quick process. If there are no objections, then company will be dissolved within 3 months from the day of application. The disadvantages of striking off are creditors or HMRC can object to the strike-off. HMRC will always object if there are any liabilities still to be paid and may object if they think there are outstanding returns or matters to be dealt with. The maximum final distribution is £25,000 for capital gains tax rules to apply. If the final distribution is over this amount, then the full distribution will be taxed as income at dividend tax rates. You also need to be careful if you've made pre-strike-off dividends to reduce the funds to under £25,000, as HMRC may argue that the intention was always to strike off the company and take the dividend into account when calculating whether the £25,000 limit has been breached. You need to make sure that all matters are dealt with before strike-off is confirmed. If any assets remain in the company, then these are considered bondification and are transferred to the Crown. Recovery of these is possible, but costs a lot of money and is not always very straightforward. HMRC do not always give formal tax clearance for strike-off, unlike in MVLs, and there's no set deadline for creditors. So if any creditors or issues emerge, then the company may be restored to the registers, or the directors may be pursued or held accountable. I'll now go through MVLs. An MVL is a members' voluntary liquidation. It's a tax-efficient, solvent winding up of a company in order to distribute assets to the shareholders. Although it is a more expensive process than strike-off, as liquidators' fees need to be paid, it removes a lot of the risk of striking off, and if the assets left to distribute are over £25,000, it's likely to produce a better outcome for the shareholders from a tax perspective. Prior to any MVL commencing, the directors of the company have to swear a declaration of solvency to show that the company is able to pay any liabilities within 12 months. The proposed liquidator will assist you with the production of this document, and it needs to be sworn within 5 weeks of the MVL start date. The declaration of solvency is then presented at a board meeting, and thereafter the appropriate special and ordinary resolutions are put to the shareholders to place the company into MVL and appoint a liquidator. Once appointed, the liquidator assumes control of the company and will lodge details of the MVL with Companies House and the accountant in bankruptcy. The liquidator will then realise the company's assets, pay any outstanding creditors, and distribute the funds to the shareholders in line with their shareholding. There are many advantages to using the MVL process to wind up your company. As a liquidator is appointed and distributes the asset, this means there is minimal risk for the directors, as the liquidator has to comply with the Insolvency Act and rules in all matters. Assets can be distributed on an in-specie basis, which, if appropriate and all creditors are covered, can be done day one. An in-specie distribution is the distribution of assets directly to shareholders rather than cash. For instance, if Derek had a vehicle in his company that he wanted to keep, this could be distributed directly to him by the liquidator rather than having to buy off the company. This can also be a useful method by which to distribute directors' loans, rather than having to repay them, just for the funds to be distributed out again in due course. Interim distributions can be done relatively quickly after the appointment, meaning that if the circumstances are right, the shareholders could have the majority of the funds in hand within a few weeks. There's also no limit on the distribution. They should all be treated on a capital gains tax basis, and if business asset disposal relief applies, this would be at a rate of 10% for distributions of up to $1 million. I'll discuss business asset disposal relief further in due course. A final date for claims for creditors will be set, giving more peace of mind that no creditors will come out of the woodwork, and the liquidator will seek and receive HMRC clearance before closing the liquidation. Clearance is confirmation from HMRC that there is no tax, such as VAT, POA, or corporation tax, for example, outstanding by the company, and they have no further claim in the process, and they are happy for the liquidation to close. As with everything, there are disadvantages to the MVL process too. Liquidators' fees will need to be paid. Costs will be dependent on how complicated the case is and what realisations or distributions are required. This would either be paid from the assets of the company or via an undertaking by the shareholders or directors. Statutory interest of 8% is payable on all creditor claims in an MVL. This is from the date of appointment to the date that the creditors are paid. The easiest way around this is for all creditors to be paid pre-appointment where possible. Statutory interest is also applicable on HMRC claims. However, these claims should now be discounted ahead of the payment due date, meaning that as long as they are paid prior to the tax due date, then there should be negligible difference. The liquidation process will take longer than a strike-off and can take between 6 and 12 months depending on what is involved. That said, should there be no creditors or minimal assets to distribute, then matters can progress quicker, albeit closure would be dependent on how quickly HMRC provides clearance. Tax matters in an MVL. It is recommended that all CT returns are completed and all tax liabilities paid prior to any MVL commencing. This allows a liquidator to seek tax clearance as quickly as possible and will speed up the MVL process. It is also imperative that you seek personal tax advice before initiating any MVL to ensure that it is the most tax efficient method for extracting the funds held. The two main matters you need to establish are that business asset disposal relief will apply and that members' voluntary liquidation targeted anti-avoidance rules, TAR, do not apply. First of all, I'll give you a brief overview of business asset disposal relief, or BADR. The highest rate of capital gains tax for individuals is currently 20%. The capital gains rate can, however, be reduced to 10% where the conditions for BADR, formerly known as Entrepreneurs Relief until the 6th of April 2020, are satisfied. Each individual has a BADR lifetime allowance on capital gains available up to a maximum value of 1 million. Any gains more than this 1 million limit will be taxed at the standard 20% rate. Where a claim for BADR is available, this must be made prior to 3 years following the date in which the company subject to the MVL ceased to trade. To qualify for BADR, the following conditions must be met. The company must be a trading company or the holding company of a trading group. The individual claiming BADR must hold at least 5% of the company's ordinary share capital and 5% of the voting rights in the company by virtue of their shareholding. The individual must also hold either an officer or employee position in the trading company or a company within the trading group. The individual making the disposal must hold the right to at least 5% of the company's distributable reserves, at least 5% of the company's net assets on winding up, or be beneficially entitled to at least 5% of the proceeds in the event of a disposal of the whole of the ordinary share capital of the company. All of the above conditions must be met on the day of disposal and throughout the 24-month period immediately preceding the MVL. In relation to Derrick and DW Consulting Limited, all the above should apply, and this should also be the case for most PSCs, although tax advice should also be sought to confirm this. I'll now give you some details on MVL TAR. MVL TAR sets out 4 conditions that must be met for the rules to apply and distribution received on MVL be subject to income tax rates rather than capital gain tax rates. Although this legislation was introduced in 2016, it remains largely untested in terms of public case law and commentary available from HMRC. This means it's unclear how HMRC will apply the criteria, which is amplified by their widely drawn nature. The idea behind the legislation was to stop people phoenixing companies by putting them into MVL to extract the funds at beneficial capital gains tax rates and then putting the funds straight back into a new business trading in the same or similar manner. Whether MVL TAR should apply is self-assessed by the taxpayer. Should HMRC challenge a claim for capital gains tax treatment on distributions, it would be necessary to provide evidence of why you believe the MVL TAR does not apply. The 4 conditions are: Condition A, the individual held at least 5% of the shares in the company immediately before the winding up. Condition B, the company was a closed company for tax purposes at any point during the 2 years ending with the winding up, a closed company being a company controlled by either 5 or fewer shareholders or any number of directors who are also shareholders. Condition C, the individual continues to be directly or indirectly carry on or be involved with the carry on of the same trade or similar trade within 2 years following the date of distribution. And Condition D, it is reasonable to assume that the main purpose or one of the main purposes of the winding up was the avoidance or reduction of a charge to income tax. It's important to reiterate that all 4 conditions must be met for TAR to apply and income tax rates become payable. Conditions A and B will nearly always apply when it comes to PSCs like DW Consulting Limited, but conditions C and D are more of a grey area. Whilst I'm not in any way a tax expert, in the case of Derrick and DW Consulting Limited, as Derrick is seeking to retire, Condition C would likely not apply, as he's not carrying on the same or a similar trade within 2 years of any distribution. If, on the other hand, Derrick takes the potential dog with Aviva, then it's likely that this would satisfy Condition C. These laws are untested today, and this seems an unintended consequence of this condition, which, as I've already mentioned, is to combat phoenixism with 2 years of any MVL rather than stopping people from working. Although the onus is on HMRC to challenge any claim for capital gains tax treatment on MVL proceeds, in order to claim such treatment, Derrick must be satisfied that Condition D does not apply before claiming capital gains tax treatment via his self-assessment tax return. Retirement or Derrick no longer having a requirement for the company but still needing to work for living costs are valid reasons for winding up the company, but it demonstrates why it's important to get personal tax advice prior to any MVL. In summary, there are benefits and disadvantages for both striking off and the MVL processes. Provided that you are happy there are no creditors or outstanding tax returns, then if you have less than £25,000 left in the company or can get to that position without any potential tax issues, then strike off is likely to be the best option. If you have more substantial funds or assets that you need to extract from your company, or if you just want greater peace of mind that all matters have been wound up fully, then the MVL is likely to be the best route. What is the better route for Derrick and DW Consulting Limited? As much as it may seem a bit of a cop-out, it depends on the tax advice Derrick receives and the timescales Derrick is looking at. Strike-off would be quicker, but based on the scenario we've outlined with MVL TAR not applying and BADR applying, then roughly speaking, the MVL would result in an additional £4,000 net for Derrick as compared to strike-off. Obviously, the higher the funds remaining in the company, the more benefit the MVL process will provide due to the availability of BADR. An additional consideration that you need to bear in mind is the potential of tax changes or increases in the budget in March, which can have a major impact on how any distributions are treated. The key is to get professional advice as early as possible so you can take the right course of action. All that remains for me to say is thank you everyone for listening to our webinar, and thanks again to Richard Johnston from AAB Wealth for his insight and input into this presentation. If anyone has any questions or wants any further information on any of the matters raised, then please email us on the addresses on screen. Thanks again for attending and have a great rest of the day.